I don't recognise that tune that we came onto. I was expecting Rocky or something like that, but anyway, there you go. Afternoon, everyone. Delighted to be here, hosting this panel once again at this fabulous event. I was at the opening drinks last night, held at Clear Capital's office, and I can tell you the sense of anticipation for IFGS was palpable. Janine in the front here gave a very powerful, energetic, passionate welcome speech, followed by some great words from the Lady Mayor and the EST. But with this audience, I'm definitely preaching to the converted. The UK has innovative regulation, amazing global talent, and an ecosystem that many are jealous of. So what is not to like? Well, one of the problems is definitely scale-up capital, and that funding is challenged. Companies get to a certain stage, the backers dry up, or they come from overseas. So at Peel Hunt, we've championed the call to reinvigorate UK capital markets, and that's why this panel here is so interesting. Dame Julia can talk to us about PISCES. Louis Taylor can enlighten us about the British Business Bank's exploits and the British Growth Partnership. Anastasia can lift the lid on the City of London's work to mobilise UK pensions capital. And Tim Levene can hopefully point to a turnaround in UK VC funding. We've been offered a whopping 20 minutes to get through all of that. So I'd probably best shut up now and just ask a bunch of questions. So let's get cracking. And hopefully we'll have a good discursive discussion. I think you can even say that. When we get onto the topic of pensions, I think it might get a bit heated. So let's see. So Julia, why don't you tell us first a little bit about PISCES, the first PISCES trades, and then maybe the state of the IPO pipeline.
Yes, well, firstly, thank you for having me. The first time I ever really talked about PISCES in public as an idea, I think, was on this stage. And I have this habit, if I say it out loud and I commit to doing it, then I have to then do it. And so PISCES is now live. Probably people can repeat after me what PISCES stands for, but for the uninitiated, it's the Private Intermittent Securities and Capital Exchange System Regulation, where the R is silent. It is the regulation that has created a thing called the private securities market, which is the London Stock Exchange's private capital venue. We have had our first transaction, so it's wonderful to have gone from talking about it as an idea to going all the way through to the creation of the secondary legislation that was necessary, to the FCA's rules, to us getting a license, to companies structuring, and now to have the deal. And that the underlying in that transaction was Oxford Science Enterprises. Done through a structure called TPE, which enabled the shares to be transacted without OSE having to go through a massive amount of repapering on its part. Hugely successful, first of a kind, but by no means the last. We are now structuring the next several transactions. And the thing that I have always thought about when you design a product is actually when people start coming to you and saying, can we use it for that? Can we use it for that? Can we use it for that? And that's what we're now finding, which is...
Just need to get the first trade done.
We got the first trade done.
First domino falls.
Exactly. But actually, whether that is secondary liquidity for staff, whether that is part of a much more structured primary into secondary flow, whether that's for special situations, we're coming up with a huge range of different use cases for it. So that is hugely exciting. In terms of the IPO pipeline, I'm conscious of time, so I'll do it quickly. The headline is really simple. We have the highest, greatest pipeline between now and sort of summer of 27. Let's give ourselves another 6 months in the context of world events and timings, since 2005. And more direct potential entrance into the FTSE 100 and the FTSE 250 than at any time that I have ever known. I think probably my entire team have ever known. And a lot of that is a direct consequence of all the rule changes that have happened. I know that they were talked about by ministers this morning. And it's entirely to the UK's credit that we have had the most fundamental reforms, whether that's the listing rules, getting rid of unbundling, we'll come to pensions, massive amounts of change on retail participation in our markets, both in debt and equity, massive change in corporate governance, stewardship, and REM, including some progress even being announced this morning, and obviously the creation of PISCES and the Mansion House Compact. All of that is feeding into a really positive momentum, and not just from British companies as well, from around the world.
From around the world. I must get probably a phone call almost a day from journalists hustling, trying to find out what is the next IPO candidate. So thank you, Julia. Louis.
You'll get more now.
Yes, I probably will. Since you were here last year, you've been awarded more government funding, so there's a correlation somewhere, which is obviously means IFGS, good for you. Where's it going? And maybe you can explain the British Growth Partnership, how it got to first close. I'll give you a minute and a half.
Great, thanks, Stephen. A minute and a half on that. So you're absolutely right. Since last year, there was a spending review, and the money from that spending review kicked in from the 1st of this month. And in that spending review, the bank was given increased resources. So we are going to be making commitments on our investment side, that is mostly venture capital, private equity, low mid-market private equity, growth capital, of 2/3 greater than we have historically for the next 5 years. And that's already started. So we're writing some bigger checks than we have done. You've seen us write checks into companies like Kraken and Wave at £25 million each in those rounds, but £100 million into a single fund. Just the other day, Apposite, a life sciences fund. And a lot of the money we're putting out there is going to be backing the 8 industrial strategy sectors, of which financial services and digital and tech are 2. So FinTech is going to be very well served. And that's really, really important. In terms of allocation around all of this, about 2/3 of what we are going to be doing is going to be in that growth and scale-up space, because that is where there is a big identified gap, and all the time trying to crowd private money in, which is where the British Growth Partnership comes in. So historically, we've only ever really managed government money, but we set out to raise our first third-party fund. And we had the first close of that on the 30th of March. Which was we were trying to raise money from pension funds to invest in the UK growth economy, because the £3 trillion of pension money that we have saved, which is a massive amount of money, almost none of it is investing in UK growth, and we want to change that. So we've established a fund. It's a co-investment fund investing in Series C+ UK innovative companies, growth companies. First investment will be Wave, autonomous vehicles, and there'll be more to come as well. It's a step in the right direction. It's a milestone in one sense. It's the first UK pension money really going into those kinds of businesses. But in a Dr. Evil-esque way, it's £200 million to start with. But we will build on this. And we've got M&G, Aegon UK, and NatWest Cushion as the first DC pension fund investors. So that's where we are.
So let's think about that as a coalition of the willing, which we'll come back to in a second. So pension investment in the UK is a huge bugbear of mine. If any of you follow me on LinkedIn, you can see I've had many a rant. What can we do with the Sterling 20? Is the Mansion House Accord going to make a difference? Anastasia, why don't you fill us in, enlighten us here?
Well, before we have a heated conversation about pensions, let me set some context. So take a step back. We initially had Mansion House Compact, which was all about how we can deploy more pension capital to growth asset classes. We then last year delivered a Mansion House Accord, intention signed by 17 DC pension funds to commit 10% of their allocation to private markets, and significant amount of that to growth asset classes. And then the government also launched Sterling 20, which is the 17 plus some additional funds and insurance firms who are also making commitment to allocate to private markets and to growth asset classes. All very exciting, but as we are now moving from the intent to implementation, we're discovering some challenges. I've been using this phrase over the last couple of months of the UK has been admiring the problem for a very long time. I'm sitting in rooms where we're still having the conversations around the structural challenges to being able to deploy that money, to sort of cultural and capability issues around being able to work with the growth asset classes, and also potential lack of incentives or some restrictive regulatory issues that are in place. So we're very much championing the mantra of let's actually move away from admiring the problem and move to action. I think Janine talked about action this morning. So we're moving to action, and we are working with partners like the BBB, and I think what Louis just talked about in terms of the initiatives that they already launched is one of those great mechanisms that helps unlock some of the structural issues. We're working very closely with Innovate Finance. We've got a FinTech scale-up initiative that we're delivering in partnership with them to look at specifically how we can direct and deploy some of that funding into FinTech scale-ups. And we are regrouping with pension funds and VCs and others to look at, one, So what does need to happen to unlock some of those structural challenges? So what is the right vehicle, what is the right mechanism that we can put in place so actually it addresses all the concerns that pension funds might have around fees or judicial duty or risk appetite? Also, how do we actually educate and elevate profile of the fact that ultimately, the UK savers are missing out. I'm Australian, so I'm quite lucky. I'm benefiting from many unicorns in this room because my pension money from Australian funds, I invested in many of the unicorns in this room.
And how mad is that? How mad is that? Let me leave that thought with you before hanging there. But thanks, Anastasia. I'm just conscious of time. So moving on to Tim. So VC investment had a tough time recently. Do you think it reached a bottom in 2025? Where does it go from here? And then also your views on pension funds and what can they really do?
So we've been on a journey. I don't know how many years we've had, Janine, of IFGS, but we're always talking about unlocking 12. Gosh, getting old. Unlocking capital. I think genuinely we've done an extraordinary job in the UK building a real established FinTech ecosystem. And we're at the point of no return. The challenge we have is we've been having the same conversation about unlocking capital. And good times come and go, but success stories breed new success. And I think what we're now seeing are really substantial, profitable, scaled fintechs that are either starting to partially exit, materially exit, and that capital is being recycled back into the ecosystem. That's hugely beneficial. What we're not seeing is that bandwagon effect of UK investors recognizing those huge success stories. And exactly as Anna has just said, we have overseas pension funds benefiting from those success stories. It doesn't always follow that those success stories, those overseas investors will reinvest back into your ecosystem. And that's what we do need to change. And so I think we've diagnosed the problem. We understand some of the challenges of why pension funds have been resistant. The British Business Bank is doing their job. They have really stepped up in a big way over the last few years, but they can't do it on their own. Your shoulders aren't quite big enough, Louis, for that.
We shouldn't.
No, and you shouldn't. And you are about catalyzing and unlocking other capital. And whereas the 200 million is a start, we know the allocation needs to be around 5%, and we are at 0.07%. So we have a hell of a long way to go. But we have to stay optimistic because I think the opportunities are there. But what we don't want to find ourselves in is in 3 or 4 years' time, and we're asking where are the next Revoluts, the Tides, the Zopas, the Starlings, the Clearbanks. Well, we want those businesses being built right now. And we need to make sure that next cohort of great UK fintech companies has that capital. And unless we can stop diagnosing the problem and identifying those issues and actually shift it into action, then I think we're going to sit here in 4 or 5 years' time and say, that's a missed opportunity. We are absolutely in a position to win, and we have been winning, but we've got to keep winning for the next decade to come. And we have all the ingredients, other than sufficient capital, in my view, to win.
And the sad part about all that is that we have an abundance of capital in this country. Yep. In fact, an overabundance of capital in this country. And how many times do we have to point out the woeful allocation to the domestic market that we see, and the far greater prevalence either of bonds, overseas equities, low-cost trackers that go into global mandates that follow the maths of largest size, etc. And there was a great piece of work came out last week. I mean, Julie, you can probably give some more detail on this, but from New Financial, but it showed a pension fund, if it had a 20% weighting to UK equities, as opposed to about 2, it would have, over the last 5 years, which includes the meteoric rise of the Mag 7, over the last 5 years, it would have outperformed 85% of existing UK pension funds that had such a low weighting to the UK. So they're clearly not doing a great job in terms of how they're compounding. And then you get that phrase, don't tell me what to do with my money, which tends to be an individual's view, but actually, you actually are overwhelmingly being told what to do with your money. It goes into a default fund, you haven't really got much choice if you want to try and penetrate an impenetrable pension fund to figure out how to change your allocation. It's very difficult. But Julie, do you want to elaborate on that at all?
Yes, I think, look, we've been, as the Capital Markets Industry Task Force, talking about this problem for not quite as long as Tim has, but I mean, feeling very much that we needed to raise the profile of the issue and then start focusing on what the solutions are. And in fact, CMIT had an agenda that I've talked about on the stage of 5 fingers and a glove when we started in 2022. We're now down to the 2 Cs, which I think Janine was talking about this morning, capital and culture, because we've done everything else. We have a world-leading crossover market now where the regulation's being copied by other jurisdictions almost word for word. You know, we have no shortage of great companies in this country. We have no shortage of capital in this country. We have a shortage of capital we spend on ourselves and a shortage of capital that's structured as risk capital. Now, most countries in the world would die for that to be the problem statement. But we do need to stop admiring the problem. And default schemes, I think, are part of it. We have been proposing through William Wright's work that actually, for the privilege of being the default scheme in the UK, you should have an allocation to the UK across whatever asset types you want to be allocated to. Now, the alternative is actually to fix the culture bit. We seem to have a debate in this country about whether we should back ourselves as a nation. It's really curious. And we forget when we turn a company into a financial instrument that it's a company that employs real people, pays real taxes, creates real jobs, creates real products, hopefully pays dividends, can recycle that capital back into the country and the economy, pays for our NHS and pays for our defence. You know? And actually, the average retail investor, if you look at how they invest, when they choose to do it themselves, they're 40 to 50% weighted to the UK. And yet, when we do it or other people do it on their behalf, they're underweight the UK. And they're underweight the growth of the UK economy. So one of the things I think we need to think about is how do we bring the enfranchisement of those pensioners who actually do want to have a different reflection in their allocation back in. The default is the default, but try getting out of it. If you get out of the default scheme, you've got to then allocate your own accumulation structures as you get older, and you're on your own. There is no choice in that regard. And so I think we need to have the cultural conversation of reconnecting the British people, not only with actively investing, but actually recognizing that it should be nuts that you're realizing more value from great British companies than great British pensioners are. One of our founding members of CMIT is Matthew Scullion, who runs Matillion. He said in the first CMIT conference, I go to Philadelphia and meet firefighters there who have exposure to the upside of the value I'm creating. I'd love to go down the road to Liverpool and meet firefighters in Liverpool who had the same exposure, but I don't. You know, we need to have that cultural conversation as a nation, and then we need to get out, we need to decide the outcome we want to achieve and just take the blockers out of it. And I think by thinking differently about default funds, we really do have an opportunity to do that. And that's a lot of what William Wright's work has been articulating.
Yeah. Louis?
Gosh, it's very difficult.
Behalf of the government.
Any more eloquent than Julia's just been. I'm not going to say anything different, but I may come from a different angle. I think there's a kind of scandal brewing in our pension industry that if you take, half a dozen UK unicorns, Wave, Kraken, a few others, say £20 billion of value that's been created in the last 7 years or so. And the amount of UK pension money that's in those is slim to none, actually. And it's not just that the pension funds have missed it, they haven't even been looking for it. And how can we miss out on that value? Second point I'd make is that, there were great news about the IPO pipeline, but there is a kind of sense that if you IPO in the UK, you get a lower valuation than you do in the US. You get a lower, well, it probably isn't true, but I mean, if it is the perception out there, it's because there isn't a bid properly in the UK from the people who used to get the call when there was an IPO or a rights issue, which was the pension funds, who were 63% of the market and who are now less than 5%, I think. So any functioning market needs more buyers than sellers, not structurally, as we seem to have got ourselves into, more sellers than buyers.
So the scandal, I think, Louis, your point is an interesting one, a scandal brewing. You've seen the pensions bill ping-pong from the House of Commons back to the House of Lords and back again. And that was the threat of using the word mandation. Those of you here last year, when I asked the panel what their views were on mandation, I don't propose doing that again because I think we're all aligned. But clearly, there is a desire for some form of incentive to try and change behaviours, but it's not clear that that's so necessary. I think there is a willingness or a desire, and it's not economic nationalism because that's a bit too socialist, but it's that nationalist feeling, that pride in what we've achieved, and everyone in this room has created something I'm sure you're all proud of, but we just don't seem to be the ones that are benefiting from it. So I think, there's a collective will here to change things. From where I'm sitting, it feels like this train that's been stuck, not moving for years, has just taken the first roll forwards. And that's got to be a positive sign, but we've got to keep our foot down pretty damn hard on this to keep it going.
I would completely agree with that. I think one sort of slight challenge that I would throw is that cultural change takes time, right? And we don't have time. We've run out of time here in the UK. So I feel like in parallel to driving that cultural change, which I 100% agree with, it's how do we create visibility, transparency, education, all of that. We need to also look at things like what are some of the structural mechanisms that we can just throw at funds and say, look, you told us all these 5 issues. Actually, this will address all those 5 issues, so go ahead and do it because you can't use those excuses anymore. And then also, I do believe in incentives. They don't have to be huge or direct incentives, but the reality is the reason why Australian pension funds invest more into domestic firms is because there is a tax incentive. Right? So ultimately, that just drives that behaviour. It's not huge, it's not overwhelmingly significant, but it's just enough to nudge them in the right direction. So I do think incentives are still important, and I think we do need to look at structural issues, but completely agree with the culture piece as well.
There is an incentive already. It's not being deployed in the right way. We've got £50 billion of pension tax relief. And fundamentally, we've given an incentive without an ask. And I think, for me, that's what we have to reframe. And I think it's staring us all in the face. And I think it's a real opportunity that we all understand why mandation won't work. However, there's only so long you can ask nicely. And, I think we need to kind of make that next big kick forward.
50 billion of pension tax relief, 9 billion of ISA tax relief, with no requirement whatsoever to use that in your own home market. There's your scandal, Louis. Anyway, we're over time. So I just want to thank the panel very much for the participation. Thank you all for listening.